here and giving you a 9.5%. This is gougingly outrageous. This is not even competitive. We have, in our industry, we call A paper loans, BC loans, and then D paper loans, which are equity or hard money loans. But BC have had different kinds of names. They call them subprime, Fannie Mae fallout, they call them portfolio lenders, niche product, alt A, all kinds of different names you want to put to anything, all kinds of loans that are not A paper. And these margins are not even competitive. They're just outrageous, especially with the balances that they have. So it was unconscionable here. It's not even humane. So the main thing on number 3 is that we want to cap the margins at 2.5%. A typical margin on an A paper loan is between 2.5, maybe 2.25, right around in there. So if we cap it at 2.5 plus your margin, it gives you a 6% interest rate, which is basically your first payment, your original payment for the first 2 years. Okay, so now while we have this moratorium and this forbearance, we have this timeout, the body's under, we're making these payments for say 3 months while we refinance, which is number 4. Number 4 is streamline the FHA Secure Hope for Homeowners program. These are 3 programs, as I mentioned earlier, that are in effect now. Streamline has been around for about 25 years. And basically Streamline is an FHA loan. If you currently have an FHA insured mortgage, you can automatically refinance so long as you occupy the property and you've made your last 12 payments on time. Okay? The reason for that is because the government is already insuring that loan. So if it benefits the borrower to go from an adjustable to a fixed, or from a fixed to an adjustable, from a 30 to a 15, or 15 to a 30, they'll insure it. And they don't have to qualify. They don't have to show income, no deposits. They don't even run a credit report. They just basically run what we call a mortgage rating, which is proof that they've made the last 12 payments on time. Now, that requires it to be an FHA loan presently. FHA Secure and the Hope for Homeowners program allows non-FHA insured loans to be refinanced through the FHA, including late payments. Okay, so what we need to do is combine these, because what got us here in the first place was not conventional, was not traditional, and everything I see on TV is people trying to resolve this traditionally and conventionally, yet they're bailing out the banks who are not insured. These loans are not insured, and federal government wants to buy these loans as if they were insured and then take a loss. Like if that $400,000 loan is going to be recuperated, not anytime soon. So what we need to do is we need to refinance these loans, and on a streamlined premise where the only requirements are that it's the borrower's residence and it's owner occupied. Well, it's the same thing. It's the borrower's residence, which we call owner occupied. Number 2, they made timely payments while the rate was fixed. That's 24 or 36. Most of them are 2-year fixes. Some of them were 3-year fixed rate loans. And like I said, here we're asking for 24, 36 payments on time, whereas Streamline was only requiring 12 months. Here we're asking for 24. Now, I would say that if they made their 2-year payment on time, but maybe they were late on the 10th month, that would be the lender's discrepancy. Especially if it was in the first year. They made all the payments on time, maybe 1 or 2 mortgage lates early on. But basically they're proving that they can make that payment. And they can continue to make that payment whether it was documented income or not. The proof is in the pudding. They've made those payments. And here we're trying to reduce the payment. So let me go on. The original purchase price was $400,000. And now we run an appraisal, and it gives us a $300,000 value, which is actually dropping. Okay, now the new loan would be 97% of that appraisal, which is $291,000. At 6%, that would give you a payment of $1,745. Now, if you can remember back to the original example, the first payment for 2 years was $2,600. Then it went to $3,400. Here we're offering $1,745. Okay. out of this loan of $291, there's what we call an upfront mortgage insurance premium. That's 3% of the balance, $87.30 in this case. That goes to the FHA. So now, this isn't a cost to the government, it's actually depositing money into the FHA. There's funds going into the FHA insurance to cover mortgages, to actually back mortgages. Alright? And there's actually two. There's the upfront mortgage insurance, which is 3% of the balance, and then there's a monthly insurance premium, which is 1.5% of the balance annually, and that's paid by the homeowner. So your payment was $17.45. Here it is here, $17.45. Your mortgage insurance premium, your monthly payment, is $363 to that insurance fund, the FHA, giving you a new payment of $21.08. That's your mortgage, not including taxes and insurance. So again, we went from 26 to 34 down to 21. Okay, we had those temporary payments where we capped the margin for those 3 months while we do this, and then you have a 30-year fix at $21.08 including mortgage insurance. Okay, let me continue back here. There's a maximum 1% origination fee of $29.10 in this case. That goes to the bank or the broker. There's a maximum processing of $4.95. And estimated closings, I used 1%, which will vary from state to state, region to region, and that is for escrow, title, etc. So after all is said and done, the lender gets net proceeds of $275,955, almost $276 out of the $300,000. The key is they get it now. They get it within the next 90 days. They get that now. Okay, so now banks must realize the inevitable. They're not going to get their $400,000 back. Neither is the government. They're kidding us. They're lying to us. Okay, they're not going to get that $400,000, not anytime soon. Okay, so banks need to realize the inevitable. And the thing is that if they're getting those payments on the capped margin, there's money coming in. There's interest, mortgage payments coming in, and when they get refinanced, if they get paid off by another mortgage, they get this in cash. So now we have mortgage payments are being paid, principal is being paid off. Now they have money, and guess what they do with money? They invest it, they lend it, they do other mortgages, they do auto loans, they do business loans, they do credit, they do all kinds of different investments. Money is flowing again, the heart is pumping again. So anyway, so let me go on to an alternative if we don't use this, because this is the answer that we've got to resolve. This is the do nothing alternative. This is traditional. Okay, they invested $400,000. Their sales price is $300,000. It took 6 months to a year to repossess the house. Remember, this is the alternative, foreclosure. It takes 6 months to a year to take the property back, and then it takes about another year to two to sell it. It's going to sit there before it sells. Right now we have an inventory of 2 years at the current pace. We have plenty of properties for sale and nobody buying. Very little demand. You got supply and demand. It's way out of whack right now. There is no demand, and then there's even less financing for that little demand. So you have 100 properties for sale. You got 2 buyers. Only one of them qualifies. That guy has a choice of 100 properties to choose from. He's going to get a real good deal. Anyways, it's going to take 2 years. So say they repossess the property, they get $300,000 if they're lucky. Property tax for 2 years, about $10,000. Again, that'll vary from state to state, region to region. Commissions, $18,000. Closing costs, repairs, buyer's closing costs. Net proceeds is $260,000 in 2 years, if they're lucky. Okay, from the last time they received the payment to the time they actually get this principal will probably be about 2 years. They invested $400,000, they're going to get $260,000 in 2 years, if they're lucky. Okay, what I just proposed, and I want to compare to, is $275,955 now, which is the previous page. Okay, this may not seem like a big difference, okay, even with the time factor, but you got to consider additional losses here. You got lost interest for 12 months is $41,000.